Hi, in this video I'm going to be talking about insurance. I'll explain why I think insurance is very expensive, that you should only insure against the things you really can't afford to have happen. I'll explain why that is and what you can do about it. My name is Lars Kroyer. I'm a former hedge fund manager who's written a couple of books about finance, and I'm now doing these videos as a hobby. Insurance is typically divided into life or non-life insurance. I'll be talking mainly about non-life insurance, but a lot of the lessons can equally apply to life insurance policy. So we all know roughly how insurance works. Let's say we're insuring our car against theft. In any 1 year, we'll pay $500 a year for the annual premium for a car that's valued at $10,000, and that suggests that there's a probability of theft of roughly 5% for that year. What we'll find out later is that the actual probability for the car being stolen that year is more like 3.5%, which the difference is down to the profit and expenses of the insurance company. So to understand all this better, we need to understand the insurance company combined ratio. So a combined ratio is the claims paid out plus the expenses and profit of the insurance company divided by the total premium income. So claims paid out, so that'll be the money you receive when you smash your car. The insurance company expenses will include stuff like claims handling, marketing, administration, fraud detection, sales, and other things like that. And the profit is pretty self-explanatory. You divide that by the aggregate premium income, so the $500 for everyone insuring their car plus other types of insurance. So let's take the typical combined ratio of 100. Now, again, you got to understand that the combined ratio varies a lot, both by type of insurance, by insurance company. It'll vary from 1 year to the next. But 100 is a pretty standard and reasonable numbers. In the 100, the expense ratio of 70, so $70 paid out, is pretty standard. The $30 in expenses of profit is pretty standard per $100 in premium income that the insurance company has received. And just to put this in layman's term, this means that on average, per $100 received, the insurance company will pay $70 out in claims, and it will cost $30 in expenses and profit to make all of this happen in this example. So going back to our example of our annual car premium of $500 a year, if the car doesn't get stolen, we obviously get no money back. Whereas if our car does get stolen in that year, we get our $10,000 back. But here's the thing that's important to understand. On average, we will only get around $350 back on our $500 premium, and it will cost us $150 per year to be insured. So the $350 is the 70% of the $500 that is the claims ratio, and the $150 is effectively the expenses and profit of the insurance company that we obviously cover as part of our $500. So the point is, insurance is expensive, and you got to make sure you need it. Now, you may think I'm a worse risk than the insurance company thinks I am, but you got to understand insurance companies have extraordinarily accurate prediction models for knowing the risk that your car gets stolen. In fact, far better than you are likely to have. So when I say that you should insure against things that you can't afford, for virtually everyone, that means that you should insure your house, you should insure your health, unless you live in a country where that's taken care of by the government. You should probably insure your car. But likewise, there's certain things that you may not have to insure against. A lot of people could afford to lose or have their mobile phone be stolen, have their vacation canceled, have their TV or other things around the house break, that spill wine on an expensive carpet. A lot of people insure against a regular dental visit that they could afford to just pay. A lot of people have pet insurance, things like that they may not have to insure against. So if this is you, figure it out and don't insure. You'll save money in the long run. But in any case, you should maximize the deductible. So the deductible is where you take part of the risk away from the insurance company. So let's say a $1,000 payout insurance, you say to the insurance company, I'd like to cover the first $200 of that. You would lower the premium from that, but you'd also send a signal to the insurance company that this is perhaps not that bad a risk. And that in turn would also lower the risk premium, leading to a double lowering of the premium for you. So it's my view that the average person could save perhaps $375 a year from not buying unnecessary insurance. The way I get to that number is I say, well, the average person in Western Europe and the US pays about $5,000 a year in insurance premium. Let's say they could not buy a quarter of that. and that quarter has a 70% claims ratio, so the 30% is the profit and cost of the insurance company. That target to the 375. Now, I think that's quite a bit understated, actually, because it doesn't include all the hassle of collection and the paperwork associated with it. It doesn't include all the keeping track of your insurance policies and finding them in the first place. It could also be bigger if you can afford to take more risk. But in any case, in summary, I would say keep in mind insurance companies know your risk a hell of a lot better than you do, and you have to be honest in your when you buy insurance. First of all, because it's the right thing to do, but also otherwise your policies won't be valid. Insurance is very expensive, so you should only insure the risk that you can't afford to have happen to you. So a good way to think about that is imagine what was going to happen to your overall economic life if your car got stolen, your house burned down, really bad things happened to you. Could you afford it? Would it ruin your life? What if your mobile got stolen? It would still suck, but you could probably afford it. Think about it like that. And it's important to note that in this video, I have not assumed better or worse luck than the insurance company. And that's perhaps a pretty accurate number. So thanks for watching. I hope you found that interesting and useful. You can subscribe to my channel if you want to hear about the forthcoming videos, or you can share it with your friends if you think they might find it useful. But in any case, I hope to see you in the next video.